house prices are not going to come down. I believe that when the real estate interest rates come down, when the mortgage rates come down, all hell's going to, oh, you're not supposed to say that. Every buyer on the sideline is going to jump into the market as long as the interest rates come down to 5 or 4%. And houses are going to go up in price all over again. I wouldn't be surprised if they go up by as much as 10 or 15% when that happens.
In the tumultuous seas of Canada's housing market, every ripple from the Bank of Canada's decisions sends shockwaves of uncertainty. From the hiking of mortgage interest rates to a probable lowering of the said rates, Canada's economic future hangs on a delicate balance. But what if those ripples turned into a tidal wave? The Bank of Canada has been hiking interest rates since March 2022. As rates rose, debt payments grew more expensive. Households were squeezed, so they spent less. Inflation has been on a steady climb from 2022 until this year. After 10 interest rate hikes, the Bank of Canada has helped ease inflation from its peak of 8.1% to a total consumer price index rate of 2.9% as of January 2024. Borrowers who've stuck it out with variable mortgages have had their payments rise roughly 70% since the start of those rate hikes. They're already coping with these new world rates. According to a December 2023 note from the central bank, monthly payments for fixed-rate borrowers with a term of 5 years or longer will increase by 25% by 2027 to a median of $1,444, up from $1,152 as of February 2022, immediately before the start of the recent rate hike cycle. However, the CMHC says that much of the rate pain will be concentrated this year and next, with 2.2 million mortgages, 45% of all outstanding mortgages, poised for interest rate shock. In a scenario where the Bank of Canada slashes interest rates to unprecedented lows, the floodgates of borrowing burst open. Canadians, enticed by the prospect of cheap money, rush to secure mortgages. The demand for housing skyrockets, and prices, already perched at dizzying heights, soar even further into the stratosphere. But as the euphoria of easy credit begins to fade, a darker reality emerges. The same low interest rates that fueled the housing boom now threaten to unleash a speculative frenzy as investors and flippers, hungry for quick profits, pour into the market. In this video, we'll embark on a journey into the heart of a probable storm. We'll explore the potential consequences of a return to ultra-low interest rates, from the rush of short-term exuberance to the looming specter of a housing bubble that could bring the entire economy to its knees. For months, the Bank of Canada has been engaged in a delicate dance with the economy, raising interest rates in an effort to tame the inflationary pressures that have been building up in the wake of the COVID-19 pandemic. These rate hikes have been a bitter pill for many Canadians to swallow, as they have made borrowing more expensive and put a damper on consumer spending. But they've also had the intended effect of cooling down the overheated housing market, which has been fueled by years of low interest rates and speculative frenzy. Now, however, there are signs that the Bank of Canada may be preparing to reverse course and start lowering interest rates once again. And while this may seem like a welcome reprieve for borrowers and a shot in the arm for the economy, the reality is far more complex and fraught with danger, particularly when it comes to the housing market. To understand why, it's vital to first understand the role that interest rates play in the housing market. When interest rates are low, as they have been for much of the past decade, it becomes cheaper for people to borrow money to buy homes. This in turn drives up demand for housing as more people are able to enter the market and compete for a limited supply of homes. As demand rises, so too do prices, creating a self-reinforcing cycle that can quickly spiral out of control. This is exactly what happened in Canada in the years leading up to the COVID-19 pandemic. With interest rates at historic lows, Canadians flocked to the housing market in droves, driving up prices in cities like Toronto and Vancouver to stratospheric levels. According to the Canadian Real Estate Association, the average price of a home in Canada reached a record high of $716,828 in March 2021, up a staggering 31.6% from the same month a year earlier. But while this may have been a boon for homeowners and investors, it was a nightmare for many Canadians who found themselves priced out of the market entirely. Young families, first-time homebuyers, and low-income earners were particularly hard hit, as they struggled to keep pace with the rapidly rising cost of housing. According to a 2023 report, families and individuals needed an annual income of over $200,000 Canadian dollars in 2023 to qualify for the average-priced home. In Vancouver, this figure was approximately 237,000 Canadian dollars. It was against this backdrop that the Bank of Canada began to raise interest rates in 2022 in an effort to cool down the overheated market and bring some semblance of sanity back to Canadian real estate. And for a time, it seemed to be working. The pace of price growth slowed, and there were even some signs of prices beginning to fall in certain markets. According to the Canadian Real Estate Association, the average price of a home in Canada fell by 1.3% in January 2023, the first year-over-year decline since the pandemic began. But now, with the Bank of Canada signaling that it may soon start to lower interest rates once again, there are fears that all of that progress could be undone in a matter of months. The consequences could be dire, and not just for the housing market, but for the Canadian economy as a whole. To understand why, it's important to look at what happens when interest rates go down. On the surface, lower interest rates might seem like a good thing for the housing market. After all, they make it cheaper for people to borrow money to buy homes, which should, in theory, lead to more demand and higher prices. And for those who already own homes, lower interest rates can make it easier to refinance their mortgages at a lower rate, freeing up more money for other expenses. But the reality is far more complicated than that. For one thing, lower interest rates can also fuel speculation and risky behavior in the housing market. When borrowing is cheap and easy, investors and speculators may be more likely to buy up properties not to live in them, but to flip them for a quick profit. This can create a bubble in the housing market as house prices are driven up not by genuine demand from homebuyers, but from the artificial demand created by speculators. We have seen this play out before in Canada, most notably in the lead-up to the 2008 financial crisis. In the years prior to the crash, interest rates were at historic lows, and the housing market was booming. Investors and speculators poured money into real estate, driving up prices to unsustainable levels. When the bubble finally burst, it triggered a chain reaction of defaults, foreclosures, and economic turmoil that took years to recover from. And there are fears that the same thing could happen again if the Bank of Canada lowers interest rates too quickly or too aggressively. Reports by the Canada Mortgage and Housing Corporation evinces the average home price in Canada could rise if interest rates fell by just 1 percentage point. And while this might be good news for current homeowners and investors, it would be a disaster for anyone trying to enter the market for the first time. But the risks of lower interest rates go beyond just the housing market. There are also broader economic risks to consider, particularly when it comes to inflation and the stability of the financial system. Purpose-built rental starts fueled by unprecedented demand and government support accounted for over half of these starts. However, unfavorable financing conditions are expected to make more new rental projects unfeasible in 2024. In 2025 to 2026, lower interest rates, milder construction cost growth, and government support should make more projects viable. Homeowners can expect lower interest rates as real incomes and confidence levels improve. Consequently, more homes are expected to be built in 2025 to 2026. One of the main reasons the Bank of Canada raises interest rates in the first place is to keep inflation in check. When the economy is running hot and prices are rising too quickly, the central bank will typically raise interest rates to cool things down and prevent the economy from overheating. However, when interest rates are lowered, it can have the opposite effect, fueling inflation and eroding the purchasing power of the Canadian dollar. This is particularly concerning in the current economic environment where inflation is already running higher than the Bank of Canada's target of 2% at 2.8% as of February. According to Statistics Canada, the Consumer Price Index rose by 3.1% in January 2023, compared to the same month a year earlier, the fastest pace of inflation since 2003. If the Bank of Canada were to lower interest rates in this environment, it could risk further stoking inflationary pressures and undermining the economy's stability. There are also risks to the financial system to consider. When interest rates are low, it can encourage excessive risk-taking and borrowing, as investors and consumers alike seek to take advantage of cheap credit. This can lead to a buildup of debt in the economy as households and businesses take on more and more leverage to finance their activities. According to Statistics Canada, Canada has the highest level of household debt to disposable income of any G7 country. The agency wrote that its 2021 census survey revealed debt-to-income ratio reached more than 180%, beating the United States and Germany by a large margin. Both of those countries posted rates of 100%. That means that for every dollar Canadian households had in disposable income, they owed about $1.85. For contrast, in 1980, the rate was just 66%. Further reports say that the ratio of Canadian household debt to income narrowed in the third quarter. The agency says household credit market debt as a proportion of household disposable income in the third quarter fell to 181.6% on a seasonally adjusted basis, down from 181.9% in the second quarter. In other words, it says Canadians owed $1.82 in credit market debt for every dollar of household disposable income in the third quarter. Meanwhile, the household debt service ratio, which measures the total amount of debt payments including interest against total disposable income, inched up, indicating that debt payments grew faster than income. This is worrying because it means Canadians are increasingly vulnerable to economic shocks and downturns, as they may struggle to keep up with their debt payments if their incomes fall or interest rates rise. If the Bank of Canada were to lower interest rates too quickly or too aggressively, it could risk further inflating this debt bubble and setting the stage for a potential financial crisis down the road. This is particularly concerning given the significant role that the housing market plays in the Canadian economy, with real estate and construction accounting for around 12% of GDP and 18% of employment. Although these industries are capital intensive, they are one of the largest employers in Canada. In 2023, 1.6 million Canadians were employed in the construction industry, which amounts to approximately 1 out of every 13 working Canadians. The number of real estate employees in Canada climbed up gradually after plummeting in the first quarter of 2022. As of November 2022, there were approximately 288,000 real estate employees, up from 224,000 in April 2020. Ultimately, however, the key to navigating this complex and uncertain landscape will be to take a long-term, holistic view of the economy and the housing market, rather than simply reacting to short-term fluctuations or political pressures. This will require a level of political courage and leadership that has often been lacking in recent years, as policymakers have been more focused on short-term gains than long-term stability and sustainability. But the stakes could not be higher. The housing market is not just a cornerstone of the Canadian economy, but also a key driver of social and economic inequality. When housing becomes unaffordable or inaccessible to large swaths of the population, it can have ripple effects that extend far beyond the realm of real estate, from reduced economic mobility and productivity to increased social tensions and political polarization. As Canada emerges from the shadow of the pandemic economic nosedive and looks to rebuild its economy and society, getting the policy balance right regarding interest rates and the housing market will be more critical. This will require a clear-eyed assessment of the risks and trade-offs involved and willingness to take bold and decisive action to address the underlying structural issues that have fueled the housing crisis for far too long. It will also require a renewed and nascent commitment to the values of fairness, inclusivity, and shared prosperity that have long been at the heart of the Canadian dream. If you like this video, hit the like button and help us spread the word. And don't forget to subscribe to get notifications on our latest news and analysis. In the meantime, check out one of these videos here to learn more. Thanks for watching.